Most people think this is about silver, but it's really about global liquidity quietly breaking beneath the surface. For over 30 years, the financial system relied on one assumption. Japan would keep interest rates near zero forever. That single assumption powered trillions of dollars in leverage across currencies, bonds, stocks, and commodities worldwide. When Japan's long-term bond yields crossed historic levels in January 2026, that assumption officially died. This wasn't a small technical move. It was a structural break with consequences far beyond Japan. Japan had become the world's cheapest source of borrowed money since the 1990s. Banks and hedge funds borrowed yen cheaply, converted it to dollars, and deployed leverage everywhere. This strategy quietly underpinned modern global markets more than most investors ever realized. Silver was one of the key markets affected by this flow of cheap borrowed money. For years, silver prices stayed suppressed despite rising industrial demand and tightening supply. That confused regular investors, who couldn't reconcile fundamentals with stagnant prices. The reason was simple. Institutions could afford massive short positions using nearly free yen. As long as funding costs stayed near zero, those shorts were easy to maintain. But when Japanese yields began rising, the math behind those trades suddenly turned dangerous. Funding costs exploded and currency moves started amplifying losses instead of offsetting them. Leverage that once felt safe became a financial trap almost overnight. When leverage trades unwind, they don't unwind slowly or politely. They unwind all at once through forced liquidation and margin calls. That's exactly what's happening now across markets tied to yen-based funding. Silver sits directly in the path of this unwinding process. Short positions funded by yen borrowing must be closed when funding costs spike. Closing shorts means buying, regardless of price or long-term outlook. At the same time, physical silver availability is extremely limited. The amount of real silver ready for delivery is tiny compared to paper claims. For years, this imbalance didn't matter because nobody demanded physical delivery. Everyone rolled contracts forward and trusted the system to function smoothly. That trust is now breaking, especially outside Western markets. Physical silver in Asia is trading at a clear premium to paper prices. That premium signals a disconnect between financial contracts and physical reality. Markets are quietly admitting paper prices no longer reflect true availability. China's decision to restrict silver exports intensified this imbalance dramatically. When the largest refining hub limits exports, global supply chains tighten instantly. Western paper markets lose their safety valve when physical metal stops flowing freely. Short sellers can no longer assume silver will always be available when needed. This change alone alters decades of pricing assumptions. Institutional behavior confirms that something major is shifting. Large players reposition before headlines change, not after. When longtime beneficiaries of suppressed prices quietly flip exposure, it's not accidental. Institutions don't announce regime changes, they act on them silently. Regulatory filings reveal far more truth than public interviews ever will. Another warning sign comes from exchanges themselves. Margin requirements rise sharply only when risk becomes uncomfortably high. Exchanges exist to protect their own survival, not traders' opinions. Raising margins signals fear of volatility and counterparty failure. Options markets are flashing similar warning signals right now. Massive contract concentration at narrow price levels creates pressure points. If prices move into those zones, forced hedging accelerates momentum. This isn't speculation, it's mechanical market behavior. Many people remember GameStop emotionally, but miss the structural lesson entirely. Thin supply plus leveraged derivatives equals explosive price movement. Silver is even more dangerous to underestimate because supply cannot be expanded quickly. Unlike stocks, physical metals cannot be printed or diluted. That makes squeezes in commodities fundamentally different and more violent. Zooming out, this is about trust in paper systems eroding. Futures, ETFs, and derivatives work perfectly until confidence cracks. When too many participants want the same outcome simultaneously, rules change. And rules always change to protect the system, not individual investors. That's why understanding what you truly own matters more than ever. Exposure through paper instruments is not the same as physical possession. In calm markets, that distinction feels academic and irrelevant. In stressed markets, it becomes the difference between protection and loss. We are entering a compressed timeline with multiple catalysts converging rapidly. Policy meetings, expirations, funding stress, and supply restrictions are colliding together. Markets hate clustered events because they magnify instability. Volatility thrives when timing compresses instead of spacing out. Waiting for obvious headlines guarantees you'll be late. By the time consensus forms, positioning opportunities usually disappear. This isn't a 5-year theory playing out slowly. It's a structural break unfolding over weeks and months. The financial system just lost a pillar that supported asset pricing for decades. That loss forces brutal repricing across leveraged markets. Silver happens to sit at the center of this transition. Prices may not rise smoothly, but old assumptions are no longer safe. Regime changes always feel quiet before they feel violent. Ignoring silver because it felt boring was logical in the old system. In the new system, that boredom may turn into shock. Understanding the plumbing now matters more than watching daily headlines. If this helped clarify what's really happening beneath the noise, stay subscribed. I'll keep breaking these shifts down clearly, calmly, and independently as this story unfolds.